might be a pretty solid investment right here.
No way. Easy.
15% cash on cash return.
It's crazy. Where's the location?
This one's
Hey guys, welcome to the show. Today we have Omar Mahmood. He's a 9-to-5 engineer, but he's en route to becoming financially free through real estate. Omar has been working the past 3 years to build up his real estate portfolio, and he has multiple properties with consistent cash flow, which is really impressive. And he's also a young guy, so definitely welcome to the show. I'd love to hear your thoughts on the market and everything that we're going to talk about.
Thanks for having me, Ibrahim. Yeah, excited to talk.
So I just had some questions about real estate. Definitely, like when you're an entrepreneur and you're beginning, you want to, and you're a little bit seasoned, you want to figure out where to park your capital. So I'm a little bit of a seasoned entrepreneur, and as I start to make money, I'm like, okay, let me figure out what I can do with it. Because one of the dangers for beginning entrepreneurs is when they start producing capital is that they start spending it on stuff that they don't need. So that's why I partnered with Omar today, and I have some questions for him about the market, and particularly for people who are beginning in this field. So,
should we carry on?
Yeah, we'll carry on.
Sounds great.
Yeah. So, your story. So I want to understand like how you got into this space and why you got into this space.
Yeah. So let's just think about it. Towards the end of 2016, right? Graduating right out of college. Fresh with a degree, looking out and saying, wow, like the earning potential is crazy right now. But as a few months went on, started to realize that my standard W-2 income job just wasn't cutting it. And then, I had a buddy that was a realtor, and at one point he sent a message to me, hey, you should check out this podcast called Bigger Pockets, and also read a book called Rich Dad Poor Dad. Read the book, found it completely mind-boggling in terms of the perception of where money is, how you work for it, and kind of what you need to do to really scale up. And so since then, I've just been learning more about real estate, going to meetups, meeting people in my surrounding area, and then just learning. And as time's gone on, eventually slowly reached a point where I now know that my trajectory is focusing in real estate and potentially retiring in 10 years.
Yeah, I mean, 10 years, like, can you beat that? That's pretty great.
Can't complain.
Yeah. I mean, that's very enticing. So currently, how long have you been doing this for?
So I've been in real estate in particular for about roughly 2.5 years. Mm-hmm. But besides that, I mean, there's always just a constant amount of learning at this point, and real estate in general is a very generic field to get into. There's so many things you can do in there, but as an investor, about 2.5 years, and as an agent, about a year.
Dang, that's good. And how's progress going with that, considering it's relatively new?
Yeah, so I mean, as an investor, I'm learning every single day more and more items. So it's kind of one of those fields where you think you're smart in the beginning, I saw a few Graham Stephan shows, Meet Kevin shows, Grant Cardone. I've watched a few of his, these podcasts. I know everything. And then the moment you jump in, you realize you know nothing. Mm-hmm. So, it's the progression's been going well. I've been learning more things every day and just waiting to see where progress takes me. Mm-hmm.
Yeah. And to that point, once you dive into a venture and then you start branching out, you get a lot bigger, you understand the learning curve of things. Because initially when I started out with stocks, that was the same thing. I was like, okay, I told my dad, I was like, Abu, I'm going to make like so much money, I'll pay for college, whatever. And instead, I just got a really harsh lesson over the next like 2 years. So, I mean, that's natural. Yeah. And, being excited for things is good, but subverting expectations and understanding the learning curve going forth when you start doing other ventures is very important. And you need to apply that same principle. Nice. Getting into more of the technicalities of real estate, credit score. So tell us a little bit about that and how that plays into investing in real estate and why that's important.
Yeah, so the beauty of real estate in general is the fact that you can leverage and get a huge amount of return for a very, very minimal investment. So putting in 5%, 3.5%, up to around 25% on a property is absolutely amazing, considering in this day and age that $20,000 can get you roughly a $500,000 asset. So when you consider that in, forced depreciation from, either renovating the property, rent rises as well, and then also the fact that you're doing debt pay down as well. So when you factor in all these other, items plus inflation and how that house will always increase with inflation is kind of a surefire way to really build up that equity.
Dang. Yeah. And I was listening a little bit of a podcast on the way here, and I heard that it's like not too tapped of a market. Like there's not as many like agents out there as other fields.
Yeah.
Like, is that true? Like, is this a field that's not really oversaturated?
Yeah, I guess to get back to your previous question, in terms of a credit score, you want to definitely look at around 700 and above just to start out with, just to kind of qualify for those really good loans. But then in regards to your other statement regarding becoming an agent and such, it really depends on your location. So if you were to go to Newport Beach, you're going to see a higher per capita agent to general population than anywhere else in Newport Beach, California. But if you were to go to areas such as, Boise, Idaho, or, other areas that are just a little bit less populated and lower income, or let's just say Compton, you're going to see less of a population of agents to people ratio at that point.
And that doesn't necessarily mean more opportunity. Like in lower income areas, there might be, like I think we talked earlier about it, it's a little bit more sketchy in regards to, sealing deals and getting like proper tenants. Yeah,
it's generally considered a lower. It's a C or D class. Just the normal grading scale. The lower you go on that scale, generally you're going to deal with more vacancy, more rougher tenants per se, and then also your houses will generally get run down a bit faster. But on the other end of that, being an agent is definitely a catalyst to pulling yourself into financial freedom, but at the same time, there's just so many ways of making money in real estate that you can be good at one particular thing and make a killing off of it. Whether it's flipping, wholesaling, becoming an agent, or just being your average everyday Joe with a W-2 job and then just purchasing rental property.
So what steps should we take? Because definitely someone that's like younger or someone who's just starting, regardless of the age, it might be a little bit daunting as to like what to do and like how do I get started in this field. So like
just from my personal experience, when you start out, you're normally not going to have the most resources, the most knowledge of what to do at that point, and it's okay to take a more conservative approach when purchasing a property, and we can go into detail on that in a few as well. But in general, jumping into real estate, or at least just one rental property within the first 5 to 10 years of you getting a stable job is an excellent idea, just to start diversifying your portfolio and really learning what you're going to be doing in the future when you start reaching those 40s, those 50s, like time frame where you're going to really want to start diversifying and getting a steady set of income coming in that Social Security will hopefully, if it's there, provide you as well. But having cash flow is definitely a huge benefit when you get older.
Definitely. So this is a capital intensive game. What are good ways to save money so that you can get started in this field?
Yeah, so from what I've done with me and my wife is, we sat down, we looked at our budget, we noted, hey, what can we save on and what can we kind of, use to accelerate specific items. So the first thing we did, and which kind of hurts me personally, was we cut down on the cars in the beginning. We went from, having multiple cars to just an old beat up Honda Accord, just very, very low insurance, very low taxes on that car. And then on top of that, just eating meals from home every day as much as we could. It kind of sucked. Beans and rice and beans, as Dave Ramsey always says. But, once we started to build up that income, that kind of accelerated the process. And then from there, not even just cutting back on stuff, considering having an open mindset of how can I afford that? Where I used to say, wow, I'd love to buy a house, but how can I buy this? Well, there's a difference between you saying how can you do it and I can't do it. So once I started to change my mindset in that way, I started to realize, wow, like I can start flipping cars and earning money off of that. Buying old cars off Craigslist, flipping them, earning $2,000 a pop every month or so, or even just going forth and mentoring people as well. I was able to earn a little bit of money off of that, or even at this point becoming a realtor, which I am now, where any sort of income I have coming in from real estate, I just recycle that back in.
Wow, yeah, that's really great, and definitely it is a sacrifice. It's not something that's easy to do,
Yeah.
So I mean, you're gonna have to live with those choices, and that's totally fine. Like if you have that long-term vision in mind, if you can manage to eat rice and beans as you said now, probably be eating lobster like 15 years from now. So definitely worth that trade. Yeah. So we talked about cutting costs and the sacrifices that are necessary in order to put money down into your investments. So how long would that take? Like once you started reducing your expenditures, you stopped eating out, you sold some of your cars, like how long did it take you in order to buy a property at that point?
Yeah, so I mean, we're a dual income household, so that really helped out as well. But once we waited for 2 or 3 months, we were able to save up enough where we started to realize, hey, we have some money. So after that, once we saved up for that initial down payment for a house potentially, we started to realize, well, if this is our first investment, we're definitely going to have some padding just in case anything goes south. So we did end up saving around 20 to 30% above what we intended to spend on our down payment, just to pad ourselves in case anything happened, the roof fell, or a pipe burst. Obviously we get these inspected, but you kind of get the gist of it.
Dang, yeah, that's smart. So a little bit more technical now. We are definitely in interesting times. So in any market that you're in, you have to consider the effects of coronavirus and like how shutting down the economy has affected everything. So from a macroeconomic view in terms of the real estate market, like what has been popping up from like a short, mid, and long-term perspective?
Yeah, so this will vary dramatically with what market you're a part of at this point in time. In Southern California, our market is on fire. It's crazy.
Wow.
I kid you not, I'm helping right now with $1 million house, and we have over 15 offers on this house. It's absolutely bonkers. I can't believe how strong the market is in our area, but that's just a short-term item right there. So as you may know, mortgage forbearance is a very real benefit to a lot of homeowners out there, where they can essentially forego paying their monthly mortgage payments and have one of 3 options. Either they will outright pay off the amount that they've been holding off on every single month. They'll either create a payment plan for that house where they will make those extra payments up throughout the next year or so. Or the most beneficial part is adding that to the end of the term of your loan. So that's essentially saying, hey, this money that we owe you right now, we'll charge you that towards the end of your loan when your money's worth a lot less. So at that point, you're paying with today's money for a stronger return later. So pretty insane if you think about it.
Dang, I was not expecting that point. Maybe from a higher income perspective, like if you are able to afford properties that are being sold off currently, like maybe that'd be helpful. But I didn't realize like $1 million house was getting bid up by like 15 people. Like yeah, it's pretty crazy. But
you were talking about short term and then also midterm. So with that mortgage forbearance that's occurring, we do intend to see a slight decrease in demand. We won't see anything like we did in 2008. That was such a strong amount of, I guess, underqualified people getting qualified at that point, that right now we have the highest rate of, equity in home ownership at this time. And then additionally, past that, we do see that we have a very, very conservative amount of people at this point that are really willing to save up and purchase, I guess, when they can. A lot of the baby boomers are starting to sell, and a lot of millennials have been saving up a ton to put their first down payment on a house. So midterm, we might see a slight depression, but because of that very strong demand, with everyone saving up for the quote-unquote next downturn, whenever there is a slight trough in the market, it will eventually end up getting shot right back up, just because that consistent demand is coming in from people noticing the market fluctuating. In terms of a long-term point of view, real estate is real estate at the end of the day. And if you look at it through a 60, 80, even 100-year study, you'll also notice that real estate will always appreciate with the market. So it's always a steady asset to go for.
Dang. Yeah. And interesting about the midterm. So, of course, timing the market is very difficult, and it's rare that anyone ever does. But what time frame would you put for that potential trough?
So, in all honesty, it's very difficult to really determine that, because in early 2019, the feds were really kind of harassing the government, stating, hey, we are going to raise interest rates. What happened in 2019? We actually had a slight depression. But then as our president had changed a few guidelines for the Fed, we ended up dropping interest rates even lower, which completely alleviated that sort of strain on the market. So with current economic conditions, we can't really determine that at this time per se, but I can say that, with all honesty, that if you're going to wait for a trough, you might lose out on the best times of investing. In 2016, when I started out, all my colleagues were telling us, hey, there's going to be a crash. There's going to be a crash. Every year we heard there's going to be a crash. 4 years later, I've made a considerable amount in equity in my property, a lot of cash flow. And with that in mind, had I been listening to people saying, hey, wait for the crash, I would have lost out on a ton of good houses.
Yeah, and that's true. And even back, I do more equity trading and more stock investing, and that similar sentiment was being portrayed in that market back in 2016 and 2017 as well. And the thing is, you're going to pay a price for calling a top. And like you said, there's a huge opportunity cost that they missed out on because he was more vigilant, and his time frame is a lot longer. So definitely something to keep in mind.
Yeah, and just something to add as well. In regards to that, this is a long-term strategy. Real estate is not something that you can kind of just sell off Robinhood or your E-Trade and kind of just jump into something else. There's a lot of fees that are involved. So when you're jumping into real estate, this is at least a 10 to 15 year investment at the minimum. So you really have to be in this for the long haul.
Dang, yeah. Yeah, and there are other ways of doing it more short term, but I think, I don't know too much about it, but I think a long-term perspective is definitely what's going to give you the best return over that time period. Because you might be messing around short-term in real estate, and there's a lot of intricacies, and that you will get outperformed by the 10 to 15 year time frame person or individual.
Oh, without a doubt. Yeah, it's definitely a long-term strategy.
Let's see. Short-term trends in California. I think we touched a little bit about this, so yeah. If there's anything else that you want to add, then we can just move on from that.
Yeah, as we all know, coronavirus is just changing everything so dramatically that if I say something now, probably by the time this video airs, we'll probably be in a completely different situation.
Yeah, for sure. Who knows, the economy might open up next week and everyone's allowed to go outside. So he's right. It's very difficult to call it on a short-term basis. I think this is a little bit more technical as well. Getting a loan. So how do you do that? Is it a lengthy process? For someone that's younger, we talked about credit score, and I think that coincides with getting a loan. And if someone has a really bad credit score and a non-existent credit score, what is something that they can do to mitigate that? Yeah,
so in general, applying for financing is generally very easy, but it can be very difficult if you're not a W-2 earner. So there are some people that are independent contractors that work on something known as a 1099. If you do have that and you do claim a good portion of your expenses on your taxes, you may have a harder time getting a loan, because lenders always want to look for that stability, and you claiming more on your taxes may reduce the amount of quote unquote income you have. And when you're applying for these 30-year fixed rate mortgages, you're going to essentially have a harder time getting those best interest rates, and then also just getting favorable terms. For most W-2 earners that work a 9-to-5 job, 40 hours a week or around that range, you're normally not going to have too much trouble kind of jumping in. But just as an advice that I always tell as a realtor and as an investor is first look at your primary living situation. If you're paying rent right now, you're probably losing money out unless you're house hacking, which is a common term that we use to essentially purchase a house and then rent out a few of the rooms and have those renters essentially pay down your mortgage for you. So once we kind of look into that and you qualify for that first time home buyer loan, which is around 3.5%, up to the standard 20%, then you can really capitalize on that 3.5% purchase with like almost 10 to 15,000 down, getting your own keys to your house. That's a pretty insane process altogether if you think about it. But
yeah, and it coincides with the self-sacrifice as well, because I think when you're a new earner and like let's say you graduate college, you want to live in an apartment by yourself, but if you look at it, that's a very huge waste of money, like $2,000 a month just to live by yourself, just so that you can say that. Like it's much worth it. Like if you can have roommates that pay you directly, I think that's a lot better sacrifice than you having your own apartment and like flexing to your friends that you're independent, but you're actually like paying like 30% of your income just down the drain. So
yeah, and I mean with studies showing that millennials are living with their parents, just something to consider. Yes, you may be living with your parents, but just imagine the amount that you could put down on a house, whether it's for yourself or for an investment. I mean it's insane how much you can really compound that interest and or profit essentially and drop that into a new rental property.
So offers. So I think you might have to explain a little bit what an offer is, and like I think this comes right after getting a loan and understanding that whole dynamic.
Yeah, so once you do qualify for a loan and get that pre-approval through, send your pay stubs and your prior tax returns, you're going to want to eventually put an offer in. So in California, at least, you normally do need to have a realtor to kind of help facilitate a very smooth transition for the purchasing process. Purchasing for sale by owner houses generally is a little bit more difficult, but when you're going through and putting in an offer, your realtor will normally do the comps, which are essentially analyzing houses in that surrounding area where that house is that you're looking for, and really understanding what kind of sales price you should be looking for. Also determining the terms for you, whether you should do 30 days to closing and how many days you need to essentially inspect the property and see how much the house is actually worth, and hopefully you're getting a good deal out of that transaction. When you consider those factors into play, having a good realtor vouching for you and really analyzing that market is probably the best bet you have to getting the best price on your house.
Because if you were to try to mitigate those things and do it by yourself, you'd have a lot rougher time of a process.
Oh yeah, I mean Zillow will normally kind of guide you towards that. Redfin, Trulia, Realtor.com, they all provide a rough estimate, but they normally go off of prior tax records, and normally that's not always indicative of the market conditions. So you could be in a very hot market and Redfin would say that your house is worth $550 when in reality comps are selling for around $600. So you have to be very careful on that end, but it's definitely a good idea to have someone that's very well versed in your neighborhood.
Dang, yeah, definitely making connections, you got to man. Getting the best offers and having the patience. So I heard I'm still definitely new to this field, but I have heard of like finding the perfect deal, quote unquote, and it might be a way of people just having cold feet to jump into the market, or them just fantasizing about something that will never come to fruition. So how can you like avoid getting stuck in that perfect deal fallacy?
Yeah, so funny you said, actually. We have a name for that in the real estate world, and for those that are in bigger pockets may know this, but it's also called analysis paralysis. It's essentially where you're analyzing properties, you're going through and you're not sure what to choose from. But the reality is, when you're purchasing your first property, the likelihood of it being the best deal you've ever had is very low. And I'd actually stress that if you actually end up purchasing a not as ideal property, but that it does meet up to specific criteria, you're in a much better shape than someone that's just going to sit on the sidelines and just consistently look. My first rental property was definitely not my most profitable, but the lessons I've learned on there are worth way more than the millions of dollars that people spend going to these real estate gurus and other sort of professionals saying, I will teach you how to flip houses. But in reality, there's nothing better than jumping in and learning on your own.
Yeah, 100%, and that goes with like almost everything that you do. Like there's a very hypothetical and theoretical way that you can look at your ventures, or you can actually just start doing it. And although you're gonna hit cold waters really fast when you just jump in, your rate of success is also gonna go up exponentially. Because there's only so much you can learn from a theoretical perspective or that you can read about. So you really need to put yourself out there, even if it's uncomfortable.
No, definitely agree.
So the most sought after part of real estate investing is what is called the returns. So what kind of returns are you expecting on a monthly basis and over the long term?
Yeah, so investors in general normally focus on a few keywords. And you'll hear these a lot if you kind of jump into a lot of real estate podcasts or just any sort of book or seminar that you go to regarding real estate. And a few of these terms are, cash flow, and then cash on cash return, and then your net operating income or your NOI, and then your net operating expenses as well. So you're going to work through a lot of those in a lot of different fashions, but generally speaking, a lot of us try to focus on that cash on cash return and cash flow. So for me, I generally try to have at least around 8 or 9% cash on cash return, and then at least around $200 of cash flow after expenses, property management, and all those other factors come into play. And so for me personally, those are numbers that I'm okay with, but depending on the market and whether you go into an A-class neighborhood or a D-class neighborhood, those numbers range dramatically. Generally speaking, the lower class of tenant you have, or the higher risk you're at for having to deal with crime or having to have stronger tenant turnover, generally the higher profit you'll receive. Mm-hmm. So it'll normally waver at that end, but it's always normally a relationship between higher risk and higher reward with real estate.
Dang. Yeah, that's a really good point. Is there any specific reason why a lower income area would yield higher profits but at a higher risk? Like, I'm just curious about the higher profit part.
Yeah, so generally speaking, you're going to come in at a much lower price point with those lower income areas. And so proportionally, that lower price for the average amount of rent in that area is normally disproportionately higher to getting more rent for such a small component that you're purchasing. So you'll notice that a house in Compton you'll be able to purchase that for, let's just say, roughly around $500,000, right? Mm-hmm. You're able to rent that out for around $3,000 to $3,100 for a full 4-bedroom, 2.5 bath house, which will house normally around 2 families, depending on the situation. When you consider $1 million house, which is double the cost, the rent doesn't essentially double as well. So your return is $1 million on $1 million house will most likely be around $4,500.
Really?
Yeah. So you're not getting anywhere near as good of a return as you would with a property in a lower class neighborhood. Mm-hmm. So.
Dang, that's very interesting. So what's one way to increase the property value? So let's say you want to spice it up and you don't want to add too much risk, but you want to increase the value. Like, what's one way that you can do that?
Yeah, so different manners of increasing your property value can range from whether you completely gut the interior and change that out. What a lot of investors like to do is we try to look for smelly, dirty houses that have good floor plans and that are in relatively desirable locations. So when you do find that house that smells like dog pee, that has holes in the wall, that still has a relatively decent roof and HVAC system, then at that point, that's really something we're trying to look for. The most dilapidated house on the market that doesn't have too many heavy hitter repairs, such as the roofing, HVAC, plumbing, electrical. When you have those kind of issues or even foundation issues, that's normally a huge red flag. And unless you're getting the house for such a steep discount where you could refinance it and kind of pull that out, it normally doesn't make sense. Mm-hmm. But generally speaking, whenever we're looking for renovating a property, we're normally going through something known as a BRRRR method. What do I mean by BRRRR method? It is to buy the property, renovate the property, rent out the property, refinance the property, and then repeat that entire cycle. So you'll hear that from other speakers that are from Bigger Pockets, and even Grant Cardone has said it once in a while as well. And this process is used very heavily with a lot of flippers as well, that do intend to focus on long-term investing.
Oh wow, that's really interesting. So like, what other trivial issues can you look for in households that might give you a better deal? You were talking about like just smell, so that's nothing structurally like integral that's really bad for the house. So what are some other things?
So a few other factors that you could consider are houses that normally don't qualify for conventional financing, where you have to get a little bit creative with your financing. And what you could do essentially is get a hard money loan, which is a very high interest loan, but you're able to get that money relatively quickly. Being that it's a high interest loan, you don't want to keep it for very long, but you can use that to renovate the property and then refinance that into a traditional house after you've renovated it. So those are really good options. And additionally, houses that have been on the market for more than 80 days roughly are normally very indicative that they're willing to do a price reduction, because more time on the market means more lost revenue for them. They're still paying taxes on that property. They're most likely still paying utilities on that property. If you can get it off their hands for a little bit less, most buyers or most sellers are willing to do that. And so that's normally something that I would consider.
Dang. So in terms of taxes, so how does that play a factor into your profits, or like how you deal with the overall your investments?
Yeah, so there's a huge benefit to working with real estate, where you can essentially do something known as depreciating your property. What do I mean by that? Well, let's just say I make $1,000 a month on a house. Well, depending on that, you can actually depreciate that $1,000 a month for the next 30 years or 27 and a half years, I believe, and always deduct that off of what you're earning on your profits, purely based off reducing that purchase price of your house every single year. So you can consistently go through there and essentially defer your taxes to a point where you're essentially not paying anything on your taxable income for real estate. Another huge benefit of that as well is that you can do something known as a 1031 exchange. A 1031 exchange is a tax deferred process where you can go from a low expense house up to a larger expense house and carry over that tax burden while not having to pay it. Let's just say you somehow pass away and your kids get that property. When within the process, you may qualify. Please speak to your CPA regarding this as well. You may qualify for your children to have that forgiven tax taken out completely. So there's a lot of huge benefits to real estate in that regard, but definitely talk to your CPA to get more information regarding that.
So contractors. So obviously, I think some people take it into their own hands to fix certain issues, but I think if you want it done right, you need to hire some contractors. So how do you do that, and how do you find good market values for their services?
Yeah, so that's a great question, Ibrahim. So when you're really looking for contractors, the best way to really focus on that is to just go out, go onto meetup.com, go on to different real estate meetups, right? I know COVID makes it a little bit difficult, but Zoom meetings are still a thing. So when you work on that, you can also reach out to a lot of either very seasoned real estate agents. They'll normally know a few contractors that fix houses during that escrow period when you're about to purchase that property. They'll be able to help you out with that. Additionally, you can start reaching out to property managers in the area. Obviously, some property managers don't want to send out their contractors' numbers, but there are a few that are sometimes willing. And if they are willing, that could be a huge gold mine for you to really understand what contractors, plumbers, electricians, or HVAC specialists you can really reach out to. And building up that network is super critical. And that's why I generally use property management whenever I'm investing out of state.
So we talked about expectation, and now that you know kind of what you're getting into and what to think about it, what are some resources that we can dive into as individuals to get further knowledge into this?
Yeah, so I mean, a few items that you can really jump into really is going on to Amazon and picking up a few books that are in regards to real estate. So Robert Kiyosaki's book, Rich Dad Poor Dad, Cash Flow Quadrant, are a few books that really help in terms of a mindset. Also, Richest Man in Babylon, that was an incredible book written way back when, but it still has relevant principles today as to how to open up your mindset. In terms of real estate books, I've noticed David's Green book on how to invest in out-of-state real estate investing has helped me tremendously in terms of focusing not in such a high value market, but going into housing markets where you can purchase houses for around $80,000 to $60,000 and have those cash flowing with only $15,000 down as a 20% down payment. So books as such. I know there's a few others from Brandon Turner as well, and many others as well. Grant Cardone as well has his. So it really depends on your cup of tea in terms of what you're looking for. But for me, David Green's books have helped out tremendously.
Awesome. Well, thank you so much for being on the show. Definitely we'll follow up with another episode, maybe a little bit more technical. But yeah, thank you so much for sharing your knowledge.
Yeah, I appreciate it. Thanks.
All right, man.